you, everyone, and welcome to this week's speaker series. I'm happy to be joined today by Joseph Graham, who leads Lord Abbett's investment strategy team. Joseph, thank you for joining us today.
Thank you for having me on that. Glad to be here.
Excellent. So, Joseph, we're going to have a conversation between you and I. We're going to talk about macro. We're going to talk about rates. We're going to talk about the Fed. We're going to talk about all the things that are on people's minds. But before we do that, why don't you give people a little bit of introduction to yourself, a brief bio, and what it is that you do, and how long have you been doing it?
Sure. Yeah, so as you said, I head the investment strategist group at Lord Abbett, and what that group does is spends a lot of time with our investors talking about asset allocation topics and different topics within our respective sectors. I cover high grade, so I talk a lot about macro and rates, and as well as the high grade market with our investment teams, but also with our largest clients around the globe, and that includes partner firms like yourselves, institutional clients, large banks and consulting firms. So I spend a lot of my time doing that, as well as producing content. And those content pieces can be the form of white papers or presentations or just little charticles that we put online or podcasts and what have you. So that's what my team does. I've been in the industry since 1999. Started as an investment banker, worked at quantitative equity hedge funds for about 15 years before taking this role at Lord Abbett.
Excellent. So it's fair to say that you have obviously a sort of 30,000-foot view of the firm's views on rates, monetary policy. Let's talk a little bit about that before we jump into some of the specific strategies that you have a bit of a hand in. Give us quickly what's the house view right now from Lord Abbett as to what the path of rates is going to be throughout the year.
Sure. So I think before I dig into the exact path, I think the biggest thing is to get the broad directionality right. You know, if you kind of knew toward the end of 21 that there were some issues with inflation, that perhaps it was more persistent than the Fed was saying, to get that broad direction right was really the most important thing, that we were on our way up. Now, I think since December of 23, we have confirmation from the Fed that the broad directionality is down on rates. Now, whether that comes, in March, which no one thinks anymore, or whether it comes later this summer in the form of a cut then, can be debated. We're of the view that the Fed is actually going to have a hard time cutting rates this year, given just persistent drivers in the labor market, in global trade, in terms of reconfiguration of trade routes, housing underbuild, deficit spending. You can put on energy transition spending. Like, there's a lot of factors that are pretty long-term factors that are conspiring to keep inflation relatively high. And I think the Fed will struggle with that this year, in addition to just being placed right before an election, right? Like, that makes it difficult for them. I think partly that's why they went in December with the rhetoric of lowering rates, because they wanted to get ahead of the election. Kind of backfired on them, because we've had some hot labor data and some hot PCE and CPI data. So I think now they're sort of regretting that. But I think as we go through the year, we do expect the Fed to be challenged to lower rates.
So going back to the December meeting, which I agree with you was obviously a pivotal moment. It was a seminal moment in terms of the path of monetary policy, at least the direction. The magnitude is a different story, but the directionality. Let's talk about that, because the Fed has been telling us since December that they're going to cut about 3 times, right? 75 basis points is their median projection for the Fed funds rate. The market went all the way to, I think it was 180 at one point, right? So more than double what the Fed was telling you that they were going to cut rates. Now, we have given most of that back. In fact, now the market is pretty much aligned with the Fed. Does the market finally have it right? Is that where it's going to be? Or do you guys think, it sounds like you guys are leaning, perhaps it might even be fewer cuts than what's currently priced in?
Yeah, I'd put us in the 0 to 3 camp. I don't think 3 is unreasonable. I think it's totally possible. then you start to get into the question of whether it's advisable or not, right? It's
Mhm.
like the Fed may do it, and it also may be a mistake to do it because the economy, in our view, look, we're at 3% plus real GDP growth. Employment is pretty tight. There's a lot of good things that are happening in the economy, and you also have some reflationary bubbles kind of brewing and things like crypto and some other parts of the market. So in our view, the Fed shouldn't lower rates 3 times this year, but they still could. And look, Powell's testimony yesterday, or his talk yesterday, was pretty dovish in our view. That, you know,
Today as well, right? Today as well.
yeah, and today, that's right. And he's kind of doubling down here and saying some of this latest data perhaps is noise, in his opinion. I'd go back to those more secular drivers that I mentioned for inflation and say that could be problematic. However, again, would stress, I don't think we're going to get a raise this year. So I think we're in that pause cycle,
Right.
and eventually going down. Where we fear a little bit more is the long end. You know, that the fact that if inflation continues to be an issue, that you could start to build that into the long end and have steeper yield curves. So we actually think the shorter end of the yield curve is a better place to be than longer.
Okay, so let's talk about that some more. You clearly, if we were to have, let's say, a reacceleration in inflation, the Fed would have to begin a new hiking cycle again. That clearly would be terrible for both fixed income and for equities. Probably even at that point, the AI leaders could probably not even survive, you know, a sort of a re-rating of a, you know, higher discount rate. But so let's talk about that, because I think that would be clearly bad. That's probably your sort of bear case, right? But let's go to your base case, which is somewhere between 0 to 3 cuts. So let's go with the median, which would be, you know, between like 1 and 2 cuts. What would that do to the long end of the curve, given where rates are today?
So what I think would happen there, there's kind of 2 outcomes, and I'll give you both. One would be that the curve stays relatively flat. This is the experience we saw in like 1994 through 2000, which was the last soft landing we really can point to in economic data. There's a lot of corollaries actually between this market and that market, where we had the internet kind of brewing. We had some rate cuts in '98 in response to Russian debt default, as well as LTCM that got the internet really, really going in terms of speculative fervor. And now we have AI that's in sort of a similar place. So it is possible that we stay pretty flat, as the yield curve did stay during that period. And by pretty flat, I mean between 0 and 100 basis points of slope between the 2 and the 10. The other thing that's possible is we have a replay of something like Q3 23, which is the dreaded bear steepener, where the short end rate stays relatively elevated. We are talking about cuts here, but the long end starts to actually steepen as people think the Fed is behind the curve, that they shouldn't have cut, and that inflation stays relatively high. We're kind of split between those views. What I'm not really talking about is like the hard landing view, which is a pretty small probability, in our opinion, that we enter a recession, that the front end has to come down super fast in order to stop slowing growth. That's what we think is probably the least likely outcome.
Right. So those comparisons to 1984 are pretty interesting.
94,
yeah.
1994.
1994, that tightening cycle, you know, it's definitely, a lot of investors are pointing to 1994 as an example of how the Fed could raise rates without triggering a recession. You know, one thing I'd like to point out to people is that the unemployment rate was at 6.5%, I believe, in 1994,
good point,
versus where it is now. And inflation was much less of a risk then than it is today, right? To go to your case of what you're fearing of potentially, which is the worst case scenario. You know, productivity growth was also much clearly accelerating back then, because that was really the boon of the internet. So, and AI might be that, but we still haven't seen that in the, let's say, aggregate productivity data. So let me ask you this. So that's sort of, so clearly, given where you think we are, which is why you're advising people to stay shorter duration, right? Now, the pushback that I would hear, or potentially could hear from that, is someone like, well, okay, that's fine. We could stick to shorter duration. I can see your point there. why would we want to take on credit risk when we're getting paid so handsomely at just with short duration risk, with T-bills paying you north of 5%? Why take on the credit risk?
Yeah, so it's a good point. You could even argue relative to T-bills, why take on any duration at all,
Right.
or credit risk. So both of those things, the reason you do it is for more return, obviously, right? You take on a little bit extra duration because as rates do come down over time, that would act as a tailwind. In addition, you don't have that reinvestment risk of rates falling, and then what I thought was a 5% in money market now becomes a 3% or 2.5%. So that's part of the reason. But credit is a little bit different. So credit over time, especially at the short end, is an incredible tailwind. Generally overpays you over time for the amount of spread you get. Right now is an interesting period where companies are very well, the coverage ratios, for example, are relatively high compared to history. So we think credit is in a good spot relative to, other kind of credit contractions that we've had, talk about 06, 07, 2001 or 2000, 2001 type of period. It just doesn't look like that today. We haven't had the excesses in credit that we saw back then. The other interesting thing is how well credit can do during an inflationary environment. So this is something I don't think a lot of people talk about because there's not a lot of data for it. We haven't had developed market inflation while there's been a developed credit market because we didn't really develop the high yield market, for example, since the early 80s, late 70s. The intuition here is that you can inflate your way out of fixed nominal debt. So the real value of that debt shrinks and companies can actually really do pretty well during inflationary periods. Margins actually hold. We have good data for that margins hold during inflationary periods, and treasurers get more conservative. So they don't issue as much debt. The read through of all that is defaults actually fall when inflation rises. So credit could be this really interesting thing where the last 20 or 30 years, it's really just been a derivative of equity risk. But in inflationary times, it could actually stand out as a different diversifier, something different from equities. That's certainly what we saw in 22, where equities were punished. Credit did pretty well during that period. So we think that could be something that happens going forward, is that credit actually acts as a diversifier, which would be certainly different than the last 20 years.
Right. Are there any particular sectors in the credit space that you find particularly attractive right now, or perhaps even some to avoid?
Yeah, so we have an interesting dynamic where everybody wants to be high quality, and the markets tend to be segmented between like high yield and IG in the corporate market. And so in IG world, everyone wants to be in single A's or stronger. In the high yield world, everybody wants to be in double B's. So you have this interesting dynamic where the weaker triple B's actually trade wider of the stronger double B's. So we really like to play that cusp in between where there's some inefficiencies between the IG and the high yield market.
Is that because the sort of fallen angel risk? I mean, is that playing into that, some of the forced selling and buying that has to happen?
I think the same phenomenon that drives fallen angel returns, which is a well-known excess return phenomenon, is exactly what I'm talking about. Yeah, it's basically people being restricted in what they can invest in and being forced to sell or forced to buy, based on a rating.
What's the counter to the fallen angels? I forget now the term for when they're
rising stars.
Rising stars. There you go.
Rising stars.
Right.
Yeah.
Okay.
Yeah. So what you're having happen is things like Ford is a rising star right now. It got upgraded into IG, and the IG market doesn't want Ford because they want the single A's and stronger. So it actually spreads widen as they get upgraded, which is sort of strange. Right. So that's an opportunity in the corporate market. We find corporate credit spreads to be pretty flat over term as well. So the pickup to go like 5 to 7 year from 1 to 3 year is really flat right now. It's about 35 basis points. I think corporate credit over term is always flat. And this is what leads to something we call the short duration anomaly, which is you want to invest in short credit instruments. They just give you high risk adjusted returns. Right now, though, it's actually, I think, especially good to do that because you're just not getting a lot of compensation to go 5 to 7 from 1 to 3. partly it's a supply issue. There's just not a ton of supply out there, but also a lot of banks, their CFO calls have been go by duration. There isn't a lot of it out there, so it's just getting squeezed.
Right. So that's interesting. So you mentioned this anomaly sort of where you're not really getting compensated for going too far out duration in the credit space. Or at least, I mean, that could be, that's it's a salient point. Would you tell us maybe what is the sort of industry benchmark or what's the benchmark duration? And what are some of your, let's say, shorter duration credit portfolios? How are they positioned relative to those benchmarks?
Yeah, benchmarks are always an interesting discussion in fixed income. So what we find is that most fixed income allocations are benched against just something like an aggregate index, which, over time has become basically just rate risk. It's treasuries, it's mortgages, it's really just one risk, and that's rate risk. What we have talked to a lot of clients about is, okay, instead of just this one risk, how about you add some credit, you shorten up your rate risk or your term risk a bit, and have more of a blend of risk. I mean, this is diversifying risk. It's kind of foundational to asset allocation. So we still think that's a good idea. Now, when you're talking about the short end, what people tend to benchmark against is like the 1 to 3 year corporate. Interestingly, what we really like is that 0 to 1 space. So it's not in the benchmark. It tends to just be abandoned by benchmark huggers. And you don't roll up the yield curve as fast, less than 1 year. Where you really roll up the yield curve is that 1 to 3 space. So we actually barbell right now between the 0-1 and like that 3 to 5 space, ending up with the same effective duration or weighted average life, but doing it through the barbell.
Okay. Are you squarely focused on U.S. Risk, credit risk, or are you also looking at other countries?
So
some opportunities.
We do look at other mainly Yankee banks is kind of our big international play, and they're dollar denominated. We do like some of the large bank risk, money center banks. We've avoided the regionals and commercial banks just because of deposit betas being relatively high and some balance sheet issues with some of their commercial real estate exposure. For all those reasons, we've avoided it. Big money center banks, they are basically run for bondholders. They are very regulated, not the most exciting equities, but really good from a bondholder perspective. And we think they're misrated usually. So a lot of times what we'll do is we'll use some of the turmoil in the commercial banking sector to go out and buy wider spreads at big money center banks.
Yeah, I mean,
so that's kind of the only international.
Yeah, that really hasn't changed much from the GFC. Like if you think about it, like it was a great place to be in the bonds of the big banks. Terrible to be in the equities. But if you were in the bonds, you got paid very handsomely for it. So yeah,
they are too big to fail. So their capital structures survive.
That's right.
And I think Credit Suisse proved that again.
That's right.
Where they went under. It was bad for the AT1 holders and different, but their bonds survived just fine.
Operating company, like I agree, you're basically owning a quasi-sovereign at that point, right?
Exactly. Yeah, and that's who we're buying in the Yankee banks or national champions. Like a Credit Suisse, like a NatWest or an HSBC, those sorts of names.
Let's talk about perhaps another scenario which I think has gotten less talk in the financial press recently. Let's talk about the recessionary scenarios, because rightfully so, all the data has been coming in quite strong and pointing to less and less chance of a recession. Where do you see the default rates? Let's say we get to a mild recession, where let's say the unemployment rate goes up anywhere from, let's say, 4 to 6%, kind of hovers, doesn't go above there. Where do you see, given current balance sheet dynamics, where do you see the default rate in the high yield space moving up to, and what's currently priced in? And I guess the follow-up question to that is, do you think, given let's say the lower probability of that occurring, are investors getting paid enough to hold that current default risk right now?
Okay, yeah, let's talk about base case, and then we'll talk about recession. But our base case right now, basically look at the distress ratio in high yield, which is about 6%. And a normal conversion of distress to defaults in a forward 12-month period is about 35 to 40%. And that's held relatively consistent. So that's pretty easy math. That's about 2% defaults based on a 6% distress ratio right now. We've done some bottom-up work as well and come to around the same number, which is pretty low. You know, it's lower than last year. I think it's lower than a lot of banks have targets on. Then you need to think about a lot of those come from triple Cs. Those are trading in the 80s right now. You get recoveries in the 40s, and that's just a guess, but that's historically what's happened. So you have 40 points on 2% of your book if you're just an index high yield strategy. So that's 80 basis points off of something that's yielding 8% plus right now. We like it, you know, compared to other risk premiums like term premium or equity risk premium. That's a pretty good risk premium. I think probably slightly more than that is priced into the market. So if you look at the high yield market, haven't looked at today, but you're probably in the low 300s. If you pull out, you know, that 80 basis points, you're in still the mid 200s in terms of excess returns. That's pretty typical and that's pretty good. So yeah, we do like that. Now, in your scenario of unemployment rising, defaults rising, a couple things would buffer it. One is the advent of the private credit market and doing refis and helping companies refi. The other is the CLO machine, which is still running, still pumping loans and buying loans hand over fist. And actually a record issuance so far this year in CLOs. Both of those things, I think, will keep defaults lower than people would think, even in a recessionary scenario.
That's an interesting take, yeah. Okay. So
yeah, and there might be more workouts and things like
level,
that.
Like, what do you target there in that case for defaults?
Yeah, it's tough to say, but I think you're at like a 5 to 6% kind of range for defaults. Look, every cycle since the 70s for defaults, if you do like a 5-year rolling average of defaults and you look at the cycles, each one is shallower than the one before it. So I think there is this idea that this is sort of philosophical, but as a capitalist system, we are less comfortable with system-wide defaults or systematic defaults. The government steps in a little earlier. They do, you know, more Keynesian economics where they pump money into the system. We can argue about whether that's good for capitalism.
You can argue whether that's capitalistic or not, but
exactly. No, exactly. I think
right.
I think you can argue that, but it is good for fixed income investors. That those cycles are shallower.
Okay, excellent. I'd like to remind everyone that if you do have questions for Joseph, please submit them directly to the chat or to me directly, and I'll be more than happy to talk about them with him. So let's jump into some specific sectors where you sort of find opportunities, or perhaps even find pitfalls. You know, like energy. Do you like consumer discretionary? Where are you finding the most value right now?
Yeah, we do like energy. We've liked energy for a long time. Now it's starting to get better priced in the marketplace, where energy names are trading inside of other names and credit. But we think it's well deserved, and that's because the capital discipline we see in the energy sector is much better than it's been over the last 20 years even. And that's just really ESG concerns. It's people, their shareholders want them to return money. They want them to have a different plan, not drill holes in the ground, which again, we can argue whether that's the right thing to do or not, but it is good for bondholders. They're paying down debt really rapidly. So we do still like a lot of, and that's E&P, you know, we're not.
I mean, the CapEx discipline has been impressive in the U.S. energy space, right? It's
and that's a good caveat where it's not globally. There is a little less restraint, but still, you know, the U.S. is a big producer, and that helps. It helps these bonds a lot. So that's one area. The other where I think we do have a differentiated view is the consumer, and that gets expressed in our strategies through consumer loans, through ABS, like auto loans and leases, credit card receivables. What you have happening with the consumer, especially the lower quality consumer, is the things that they spend money on, like gas and food. Those are actually deflating faster than everything else. What's really tough on inflation is wages. So the real wages of the lower income consumer, lower FICO score consumer, are actually expanding at a pretty rapid rate. We're talking 4% plus. That combined with low unemployment it's a pretty good situation for the consumer. You do have these like seasonal effects of rising delinquencies at the end of the year. You're coming off some really low levels because of all the, government handouts that we had. But we see that as more a return to normalcy when the consumer, when you look at it, is really in pretty good shape. So that's another area that we're taking advantage of.
Okay, so Joseph, with the few minutes we have here, I have some questions that have come in. So we have one question on the U.S. election and how that could potentially impact credit markets in your view. Either of the scenarios, maybe we can talk about your sort of base case if you have one, and if you do, sort of how that could potentially impact.
Yeah, the base case on elections is that they don't matter too much, and that we should, stick to talking about markets and coverage ratios and what's actually happening with fixed income markets. But there are risks there, of course. One of the risks that we're looking at is a possible alignment of the House, the Senate, and the presidency, the executive branch, in addition to possibly some politicization of the Fed. If all those things sort of lined up, we would need to be really wary of inflation, because that could lead to spending.
In which direction, but whether it's Republican controlled or Democratic control?
Could be either. If you have that kind of alignment, and then you can push through bills, spending bills, you can actually possibly.
There's no. I mean, neither party is arguing for fiscal restraint nowadays, right? That's the thing.
Right. There is a segment of the Republican Party that that is deficit hawks, but they're not the majority.
But they're not the majority, right? Yeah.
Exactly. Yeah. So they could get overwhelmed by the pro-business, spend mentality. That combined with perhaps removing Powell, which Trump has said he would do, and putting in somebody who's just more in concert with fiscal policy, that could be dangerous for inflation. So that is one. I think it's a low probability of all those things happening unchecked, but there's something we're watching.
Okay. And finally, any comments on China and the recovery there, or the lackluster recovery, let's say, and how that could potentially be impacted by, let's say, a Trump administration who has, Trump has publicly now said that he wants to impose tariffs as high as 60% on Chinese goods. There's some debate as to whether he could do that unilaterally, right? So maybe if you have some thoughts on that, and what the potential global impacts could be.
Yeah, I may sound like a broken record, but the real read through of that is higher inflation, because it makes supply chains more expensive to reshore things. One of the tightest links in all of economics, like if you look at the data, is tariffs lead to higher prices. So that's what we'd be watching there. In terms of China,
something that people don't remember, because sort of the whole narrative was hijacked by the pandemic, but people will recall before the pandemic, we were already starting to see signs of inflation picking up, partly due to the tariffs, but also some of these other structural forces that you're talking about that are, basically all pointing in the same direction. So,
yeah, I agree. And look, I don't mean to sound too negative on the prospects for inflation. I do think we're in a restrictive stance right now, and with rates at 5.25. And I think our base case is that we actually end with a softer landing, and that inflation remains an issue, but not an issue that's out of control. And
right,
I think,
like structurally higher than it was over the previous 20 years, but not
exactly
what we saw in 21, obviously, where we dislocated. Yep. I mean, look, we agree with you, meaning like as a house and myself particularly, that sort of there's larger structural forces that are all pointing in a sort of systematically higher inflationary landscape, with the big caveat that if we truly have the onset of a true general purpose technology, with like AI things, that could be very disinflationary, right? So that could be the sort of the Deus ex machina that comes into the picture and points everything in the opposite direction once again, right? So
I
kind of see that too, right? With the market, it's tossing with that right now. It's trying to figure out, is this really a very transformative technology that's going to have massive productivity and profitability gains throughout, or is it, more like the iPhone versus, the internet, right? Something like that, right?
Yeah, no, and that's our base view, is that this looks like the internet, just because we don't have other modalities to compare it to.
Right.
So yeah, and if it looks like the internet, it's interesting. What you see at first is a lot of large cap gains, and then as the infrastructure gets there, small caps are able to compete with large caps in a better way. And then the next, it's kind of 5 years where large caps outperformed in the internet boom, and then the next 5 years were the small cap era. So we'll see, but that's what we would expect out of this.
Yeah. Excellent. Well, Joseph, really appreciated the conversation. Thank you for taking the time. I know you're in a hotel, so we appreciate you taking the time out to join us today. And please just tell everyone again, perhaps some of the strategies that they could look into if they're interested in some of the topics and points you brought up.
Yeah, good point. We didn't talk about the strategies, but Lord Abbett short duration income is what we would recommend for a lot of clients for their fixed income allocations. In addition to core fixed income, it can be a really nice complement to, as we talked about, lower that rate risk, add in some credit risk, and earn higher yields than you would in a cash or money market account. So yeah, short duration income is something they should look into.
Excellent. So Joseph Graham from Lord Abbett, thank you so much for joining us. Have a great
Thank you.
weekend, everyone. Take care. Bye-bye.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.